Hello students, welcome to week 5 of Accounting Principles. We're halfway through the course now. If you have any missing assignments at this point, get with me so that maybe we can work something out. Even if it is late, maybe I can work out a deal with you. At least you get something versus nothing. No promises though, but at least reach out to me. I think you're going to like this week's devotion, so be sure to check it out. And don't forget to read the assigned chapters from the course text. All right, let's take a look at what we're studying this week in chapter 12. Actually, we are going to hit chapter 12 and chapter 13 this week, so a lot going on. Let's take a look at chapter 12 first on partnerships. This week we're learning about the definition of a partnership form of business and identify its principal characteristics. And we're also looking at how to how to record partners' investments of cash and other assets when they form a partnership with somebody else. As well as understanding, we're going to look at as well understanding how to account for the income or losses that partners share. So by definition, a partnership is an association of two or more persons to carry on as co-owners of a business, a going concern, for profit. In the business where I work, 4 family members formed a partnership called a U.S. Staffing Agency. Legally, it's an LLC in our state, but it is recognized as a business partnership type of business. Now, unlike a corporation that we're going to look at in a moment out of chapter 13, in a partnership, there's no economic separation between a partnership and its owners. So this is a quick look of the advantages and the disadvantages of the partnership form of business. Notice on the one of the disadvantages is the unlimited personal liability of the partners or the owners. So if you do get involved in a partnership, make sure that make sure you get enough personal liability insurance coverage. This is a pretty important point. That's why I'm going to make sure you get this. If you're in a partnership, make sure you get personal liability insurance coverage for yourself and your family and your partners. You can't have enough personal liability insurance, especially in a partnership. From an accounting perspective, a partnership is similar to a sole proprietorship, but with some differences. For example, owner's equity in a partnership is called partner's equity, not owner's equity. Plus, the accounting system needs to divide up for each partner the income and losses along with, separate capital deposits and withdrawals for each of the partners. So for example, when you take a look at this slide, this graphic here, you can see the partnership capital deposits and withdrawals for each of the partners. Sand is one partner and Kira is another partner. It's different than a sole proprietorship where it's all lumped together underneath the one owner. So a partner's liability, income, and loss can be distributed according to whatever method the partners specify in the partnership agreement. It's a legal document called the partnership agreement. If the agreement doesn't specify the distribution of losses and income, the partners share in both of those equally. Now, if you get into a partnership arrangement, make sure you understand before you sign any legal document that you understand your obligation as to how much you're responsible for should losses occur, and that you understand how much the profit you're going to share in should that occur, and hopefully it will. All right, be sure to read more about partnerships in chapter 12. Let's look at chapter 13 for a moment and talk about accounting for corporations now. So we're switching from partnerships to corporations. In this chapter, we define the corporate form of business and its characteristics, and we're also going to learn the components of stockholders' equity and those characteristics. And we're also going to understand how to calculate dividend yield and return on equity and define stock options. All those are part of this chapter coming up in chapter 13. So by definition, a corporation is a separate entity chartered by the state, and it's legally separate from its owners and stakeholders or stockholders, unlike the partnership. Contributed capital refers to a stockholder's investments in a corporation. So a single unit of ownership in a corporation is called a share of stock. From a macro view, stockholders invest by buying shares of stock in the corporation, and they elect stockholders to the board of directors, and then the board of directors hire the CEO and the management team to execute the day-to-day operations of the company. Now, in simple terms, let's talk about stock for a minute. Um, there are two different types of stock for stockholders. There's common stock and preferred stock. Common stock is typically the types of stock that we would buy. For example, if I was to go buy stock or my 401k or my IRA, they're buying common stock. Preferred stock is usually reserved for the founders and the key employees, key stakeholders in the business. Now, there are a number of important metrics to consider when you're measuring the success of a corporation. So we'll talk about three of them for right now. The dividend yield is computed by dividing the dividends per share by the market price per share. So this gives stockholders an idea of the return on their investment for each share of stock that they own. The return on equity ratio answers the question, how much does the company earn on the total investment from stockholders? So the higher the ratio, the better the company's doing. And finally, the PE, the price to earnings ratio, is a measure of confidence by investors in the company's future. If you watch CNBC a lot, and I do, I think it's very interesting to watch CNBC. And they talk about stocks all day long. They talk about business all day long. And so very interesting. So if you get a chance to watch I'm not talking about MSNBC, CNBC. It's really interesting. So price to earnings ratio comes up a lot. This ratio is considered one of the fundamental analysis on whether investors buy or not buy a stock from a particular company. So it's calculated by simply dividing the price per share by the earnings per share. Now, the higher the ratio, the more confidence investors seem to have in that particular company. So be sure to read all about these ratios and more of them in Chapter 13 on corporations. Okay, I know it's been a long overview, but it was two chapters I had to get covered, so I wanted to hit the important items for you. Thanks for hanging in there with me. Remember to get your quizzes and discussion questions done and that sort of thing on time this week. And remember, God is on his throne. He's always been there. He's always going to be. Have a great week.